Before we talk about stocks, before we talk about real estate, before we talk about crypto, business ownership, or passive income, we need to talk about you. Because the first investment you make isn't in an asset class. It's in your ability to manage your own risk tolerance. This is what separates consistent wealth builders from emotional dabblers who panic every time the market hiccups. What is risk tolerance, really? Risk tolerance is how much uncertainty, or even temporary loss, you can stomach before you start making bad decisions. It's not about how brave you think you are. It's not about what your favorite finance YouTuber is doing. It's about how you behave when the game doesn't go your way. Are you the kind of person who doubles down when there's blood in the streets, or sells everything the second your portfolio turns red? Both reactions tell a story, and that story affects your results. There are three types of risk tolerance. Let's break them down. Conservative risk tolerance. You prioritize safety and preserving capital. You'd rather grow slow than experience big losses. You sleep better knowing your money is safe, even if it's not working that hard. Moderate risk tolerance. You want growth, but within reason. You can handle dips, but not free falls. You think long-term, but still check your accounts when markets get rocky. Aggressive risk tolerance. You chase growth. You're not afraid of volatility. You see risk as a tool, not an enemy. You're emotionally built for long winters and big bets. Which one are you? Think about how you felt during the last crash. That's your real answer. Why? Knowing your risk tolerance changes everything. Because your risk tolerance determines what assets you should even be investing in, how much cash you need on hand, how long you should hold, how diversified you should be, what strategy will actually work for you. If your portfolio doesn't match your risk profile, you will eventually make a decision you regret. What to expect as a new investor? Let me break the illusion for you right now. You will lose money sometimes. You won't time the bottom. You can't avoid every downturn. And yes, sometimes you'll feel like giving up. That's the emotional tax of investing. The real reward comes from staying disciplined while others flinch. Discipline is how wealth is built, not luck, not genius, not guessing. The emotional roller coaster of investing is real. Investing isn't just math, it's psychology. Here's what the emotional cycle looks like. Optimism. This is a great opportunity. Excitement. Look at those gains. Thrill. I'm a genius. This is easy. Euphoria. Peak risk. You're all in. Anxiety. Why is it going down? Denial. It's just a dip. It'll bounce back. Fear. What if I made a mistake? Desperation. You start doubting yourself. Panic. You sell. Usually at the bottom. Depression. You swear off investing. Hope. You dip your toe back in. Relief. Things recover. Optimism. Again. The winners aren't the ones who avoid this cycle. They're the ones who don't let it control their decisions. How to build discipline as an investor. Discipline isn't a trait, it's a system. Here's how to build it. Have a written investment plan. Don't wing it. Write your goals, asset mix, and rules for buying or selling. Use automatic contributions. Remove emotion. Automate deposits to your brokerage or retirement account. Avoid watching daily market news. Daily price noise creates stress. Focus on long-term trends and performance. Rebalance on a schedule. Don't react to the market. Adjust your portfolio on a preset calendar, annually or semi-annually. Track, but don't obsess. Use tools to monitor progress, but don't check them every hour. Study market history. When you understand market cycles, you stop being afraid of them. Surround yourself with long-term thinkers. Community affects mindset. Follow people who talk about decades, not days. Investing isn't supposed to be exciting. If your portfolio gives you an adrenaline rush, you're doing it wrong. Boring, consistent, system-driven investing is what gets results. Because here's the truth. Wealth grows through time plus discipline. Flashy bets often lead to heartbreak, and the best investors are usually the calmest. It's important that you are thinking through the investment decision. Before you buy anything, ask yourself, do I understand the asset class? Can I hold through a 30% decline? Is this money I can afford to lose or lock up? Does this investment align with my long-term goals? Am I chasing returns or building wealth? If you can't answer these clearly, you're not investing. You're gambling with nicer packaging. Start with your mindset, not your brokerage account. Here's the secret no one tells beginners. You can succeed in real estate. You can succeed in index funds. You can succeed in small business, dividend stocks, crypto, you name it. But only if you know who you are as an investor. Your psychology, your risk profile, and your consistency matter more than any strategy. If you want to win in the game of money, forget quick wins. Focus on patience, systems, risk-adjusted growth, and knowing yourself better than any market signal. The most powerful portfolio isn't just one filled with assets. It's one backed by a mind that won't break when things get hard. Be that investor, the one who builds wealth slowly and keeps it for